How to do futures pairs trading edition here for you, and this is especially relevant given the current landscape of equity markets, which is going to be our go-to example for today's presentation. As equities have gotten kind of stale at the highs, people trying to find different opportunities in what has become, until actually today, a pretty boring equity market. Pairs, thankfully, giving us trade ideas for any type of market. Before I get into all the merits of pairs trading, what you look for when you're trying to put together a pairs trade, how you put it together in your actual trading platform, and all that good stuff, here is a disclosure that I need to put in front of your eyes so that my compliance team here at the small exchange does not get mad at me. I think that's enough time spent there. So let's get on to it. So pairs trading is a neutral strategy that uses offsetting positions in two highly correlated products. And in today's example, we're going to be using primarily the small technology futures and the small stock 75 futures. Those are two equity index futures from the small exchange here. That being said, you're going to be able to transfer all of today's presentation to any different product type, any different asset class that you're looking at. If you like to trade equities, but you're trading in the micros, or you're trading smalls against micros, or you're trading ETF shares against futures, or you're just trading ETF shares against shares, you're going to be able to transfer all of that stuff. But let's get comfortable with these two characters because they're going to be the main characters of today's story. And as you can see here, these two markets move together, and they converge, they diverge, they move back and forth. It's not a one-for-one relationship. As you see, they fell lower in the early part of 2020 with the COVID news starting to circulate around financial markets. And then the bounce back was very different for this technology stock market and the broad market in SM75. So getting comfortable with those characters and pairs trading in general, I want to now move on to a different representation of these same two markets. So what you're going to see here, same time frame, same two markets, but what the pairs itself actually looks like. This is the visualization of that single pairs market. Now it's the same thing that you just saw, those same two players, same time frame and all the rest, but you are hopefully thinking about it and visualizing it now as a single diversified market. That's simply the difference between those two markets that I just showed you there. And what you see here right off the bat, hopefully, is how different the movement is from those outrights themselves. You've created already a market in and of itself, a new unique price here that's traveled from January 2020 until the present that looks a lot different than the two component parts of it. If I just go back and forth really quickly, sticks in SM75, the two pieces of the pairs trade on their own, and then when you combine them together, you create this unique price that looks a lot different and presents a lot different opportunity. We'll get all to that opportunity, how to gauge it, how to deploy it in your trading platform later on in the presentation, but I just want to stay on this little example here before we get into a more thorough approach to pairs trading, because it's as simple as combining those two equity index futures into this single price and thinking about it as simply, okay, it's these stocks versus those stocks. SM75, the top 5 holdings right now are Tesla, FCX, CRWD, TTD, and Wayfair there, rounding out the top 5. Very different than the STIX top 5, where you've got obviously more technology-oriented stocks, but just different in general. You got Zillow there, Snapchat, TSM, Square, and Moderna. And so what I'm doing here in a pairs market when we're thinking equities is if I'm buying SM75 and selling STIX, I'm on that side of the pairs, then I simply want these stocks over here on my left to perform better than those stocks on my right there. And what's great about that, and we'll get into this a few times throughout the presentation, is I can profit from bearish or bullish markets, since the trade that I put on actually depends on the relationships and not the outright direction themselves. And this has been really a godsend to a lot of people in recent weeks and months as equities have just made new highs after new highs. Pairs trading has supplied people with a unique opportunity that has said, okay, I don't just have to buy into these new highs here on Wednesday afternoon, or I don't have to just sell another new high if I'm a contrarian. I can put this trade on, this relationship trade that can profit if equities are higher tomorrow or if they're lower. All I want is this relationship, the ones that I bought here. That if I bought SM75 and sold sticks, I want Tesla and that bunch to outperform the other ones. And it could be a matter of, those stocks on my left being down 5%, but the ones on my right are down 10%. I win that way. Or to the reverse, the ones on my left could be up 5% while the ones on my right are unchanged. There's so many different ways when you add two markets together for it to work in your favor, and also obviously the risk of it working against you. But it's a unique trade there that doesn't matter relative to the asset class itself, whether that's moving up or down. So let's get into how you create these pairs trading ideas and what they can do for you. Some of the benefits of pairs trading before we launch into how idea generation in pairs trading. You can speculate on relationships and not direction of assets, which is really, I think, a great tool to have in your tool belt. It's similar to any of you out there who've traded options. One of the first things that you learn after your basic covered calls or buying or selling just a naked put or call option is, hey, I can go into the S&P 500 or I can go into Apple and I can sell what's called a strangle or an iron condor, and I can have a neutral outlook. That's really intriguing to, I think, a lot of people who are tired of saying, oh, trading, I need to go in there and make a 50-50 speculation on where this asset is going to be tomorrow or next week or next year. It's that different kind of speculation that pairs trading offers. Also, it allows you to offset risk that single markets can pose and extend time. Now, this is something that I'm excited to go deep on because it's not the first thing that people think about. But given the current landscape, a good example of this, might be the fact that stocks over the last couple of months have, gone higher and higher and higher until actually today. But what you can do to offset the risk of just selling stocks maybe a week ago or a month ago is you sell some stocks, like in that example of SM75 versus sticks, and then you buy some stocks somewhere else. And what that does is it offsets, it hedges some of that risk of a single market just ripping either for you or against you, and it extends time in the trade. If you went into that short trade saying, I'm willing to only lose $500 in this trade and I'm trying to make $500, putting together a pairs, as long as they're highly correlated, will make that $500 go further in terms of time, as long as, like I said, you've got two highly correlated pairs. We'll get into correlation in a little bit. And finally, and this might be for some the most intriguing benefit of pairs, is the diversification that it lends. This is great because like I said, a lot of people maybe get tired of picking a direction on asset classes, but that's not to say that you're just never going to do it. I think even if you have the most neutral outlook on stocks and metals and interest rates and everything else, you're almost always going to have some kind of directional play going on. Your long stocks, your short stocks, you have a 401k that's maybe invested in a stock and bond fund. What's great is putting together a pairs trade in equities or putting together a pairs trade in interest rates or metals or anything down the line. I've found through years of research that those trades are very diversified from the movement of the asset class itself. Now, what does that mean? That just means that if I'm long, say Apple, and then I put on a pairs trade of Apple versus Amazon, my long position in Apple and my pairs trade of Apple versus Amazon are usually going to move regardless of the outrights itself, right? So you've got this pairs price that's moving around that's actually usually uncorrelated to the outrights themselves. So you're gaining diversification with these strategies that you're adding to your positions tab. So where do we start? Here in pairs trades, it starts with just one market. All right, you go into an asset class and you're like, all right, this thing looks intriguing here, but I don't necessarily want to go long and short it. I want to compare it to something else and maybe get it's almost like a different kind of derivative, right? When they talk about options and futures as being derivatives of the indices or the basic markets themselves, this is like a derivative strategy to me, where it's like it starts with this one part, and now I'm going to add some things to it to create a whole different strategy. And going from this launching point of just one product, SM75, you can find here pairs opportunity between the two markets with strong correlations. For example, SM75 is made up of 5 sectors. So what I can do here is I can say, all right, 20% technology, 20% materials, energy, industrials, and financials in the SM75 itself. Well, I can trade that index against one of these sectors. This is one of my favorite things, because you know the correlation is going to be there because the sector itself is part of the index. And 2, you can almost always have a strategy within this type of pairs trade, which is, okay, I can maybe buy that orange SM75 line against selling the big outperformer there, tech. That's a contrarian trade that now isn't just directional on stocks in general, but the relationship of the outperforming sector against the index that holds that sector. Or I can sell that broad market SM75, which holds all 5 of these sectors. I can get short that stock market, and I can offset that risk or create a pairs trade by buying the underperforming energy sector. And I know a lot of people who've done some research or who have been just in the know on sector rotation recently will know that energy, that brown line that has been beat up for so many months and so many years now, has actually outperformed tech in the last couple of months here. And I know it doesn't look like it, but you can see that bounce from those lows in November outperforming the tech sector. So there's opportunity on all sides of the components from just a simple index as you start to dissect it a little bit. And also I've in the past gone as far as not only diving into a sector of an equity index future, but diving into a single component of that sector, of that equity index future. I could make a trade here out of SM75 versus the Apple stock that makes up a portion of the tech sector of SM75. So already I hope the gears are turning, that you can see there are so many permutations, so many different ways for you to formulate an opinion on what started with a simple equity index that's like, oh, well, it's up another day here, and there's not too much to do. Already so many different things to do when you're simply relating the sectors. And also relating similar products. You can go kind of laterally from SM75 to other equity index futures. You can go from our small index to the NASDAQ, to the Russell, S&P, and Dow, and formulate an opinion there. Now you've got not a group of stocks in the index versus a component piece, but a group of stocks versus another group of stocks, similar to where we started, the SM75 versus sticks. This is really intriguing. And I would say this is probably the most popular, especially in equities, is trading indices against indices, especially in equity futures, because it's very cost efficient and it's pretty easy to trade these off of each other. But similar to that sector, how the performance relates to our SM75 here, you can already kind of see, oh wow, I've got hopefully I've got some opinions on whether or not I would get long the SM75 against short NASDAQ, or maybe I'm long Dow, the underperformer, against the S&P or NASDAQ or SM75. Already, once again, adding a few characters to the story here creates for so many different opportunities. And then the Wild West of pairs trading, different asset classes. Now this is where you're going to find your weakest correlations, but some of the most intriguing stories. I don't necessarily advocate for starting here, but there's a lot to do, and I've definitely on small stakes done some recent research on Stuff like yields versus equities. That's a popular one. And then also, how does the US dollar relate to crude oil? That's another one. And how does Bitcoin factor into all these? Is Bitcoin a currency? Is it similar to the metals asset class? Is it similar to the risk on markets in equities? You can trade all these different things against each other, and pairs are really the medium, the vehicle for getting these opinions done in your platform. Because I have to imagine, simply presenting these markets in this manner already driving some differing opinions from you out there in the audience. So those are the three different spots that I tend to look for opportunity in a pairs trade when I'm just given a platform with a bunch of different tickers, a bunch of different product types, and everything else. And I know that a lot of people want to know what's the correlation. What is the actual measure of these two products that I tentatively want to trade? And hey, good on you, because that definitely is a source of comfort, because it lets you know these two things that I'm trading, they have a good interdependence that makes sense for me pairs trading them, right? Like you wouldn't pairs trade the cost of fuel against the price of an apple per se, or something that at face value doesn't have any relationship there. And you can see the SM75 sticks, our example for today, has a positive correlation of 0.75. Now correlation runs from -1 to +1, so positive 0.75, pretty good. I'm usually looking for correlations to either be above 0.5 or below -0.5. Now, don't forget about the negative side of this in your pairs trading, because that's cutting off a lot of potential for opportunity. And it's a little bit more difficult to grasp, I will give you that. But markets that are highly negatively correlated offer, similar opportunities in pairs trading. This is until we came out with the small 10-year future. This is how a lot of stock bond pairs trades would go, because bond prices risk off asset class, stock prices risk on asset class. If stocks move higher, bonds tend to move lower. So I wouldn't buy one and sell the other. They're negatively correlated, so I would buy one and buy the other, or sell one and sell the other. And that's how you use that negative correlation. But this is all to say that's kind of deep in the weeds. And I know that people are interested in correlations, and our small exchange subscription feeds you these correlations between our products and other similar products that you could pairs trade against. So be sure to check that out. You get that content every week. But I would say, if you know that a market is highly correlated, like S&Ps and Dow, obviously highly correlated, you don't need to worry about this value every single day. It doesn't need to be updated for you every single week, because that relationship, unless there is some kind of crazy, stock market anarchy, and the stocks that are in S&Ps just start acting completely different than those in the Dow, not to mention that there is a fair amount of overlap between the holdings of both of those indices, you really don't need to worry too much about correlation on a daily basis. If I know the things are highly correlated, I don't need to update those values. And if two stocks or two markets are part of the same asset class, and I've watched them trade and they usually are both up or both down, I can feel pretty confident that they're good component pieces of a potential pairs trade. But let's get into some math that you actually probably do need to do. Don't worry so much about the number crunching on correlation if you feel confident in the relationships that are there, as much as making sure that your ratios are tuned up. And you'll see here in a second in our examples, thankfully in small exchange products, almost all of them are sized very similarly, so they're almost all 1-for-1 trades. Now, other exchanges that create go public with single stocks or create other futures, this is not going to be so easy because and it's not to try to make them look bad. They created different products at different times for different people and different uses, but you're going to need to do a little bit of math when you're trying to size up say an E-mini S&P against an E-mini Russell future there. So it starts out with this, the simple pairs trading formula, which is what is the price of this thing, what is its futures multiplier, or if it's just stock, I'm usually just starting out with that multiplier of 1 share. And how does that compare to the other leg, the other piece of my pairs trade? And that's going to output for me a ratio. So like if my front leg, the price times the multiplier is 1,000, and my back leg, the price times the multiplier is 2,000, then okay, I got 1,000 over 2,000, that's 0.5. So I need twice that front leg to get back to 1, right? And that's an easy example. Hopefully you can do that in your head, where if the value of, the front leg is 1,000, the value of the back leg is 2,000. Obviously, I need to jump up the size of that front leg to get me to an equivalent basis there. Where we add a little bit of intricacy to the process here is when we're usually outside of asset classes, or we're dealing with just two very different products that are still highly correlated, either negative or positive. We add the volatility piece in here. And now this is something that if you want to go with the more advanced pairs trading formula, always be my guest, but I don't necessarily do this when I'm in like the equity index world, because usually, as you can go in your trading platforms right now, and I feel pretty confident that I'm not being a complete idiot here, when you jump from like NASDAQ over to S&Ps, you'll see a pretty minor difference between the volatilities. So I don't necessarily adjust when I'm inside that same asset class. Now, that being said, if the volatility of when you're dealing with single stocks, like for instance, the big buzzwordy stock that's floating around right now, GameStop, if you were going to make a pairs trade out of GameStop and EA Sports, you'll probably see that GameStop's volatility is like 20 times that of EA Sports. Now, that's when I probably am adjusting for volatility, when those products aren't very similar. But all you have to do at the end of the day is just add this one parameter. And so now, in my prior very simple example, the price times the multiplier front leg is 1,000. It's worth $1,000, and the volatility of that product is maybe 50% IV. Now my back leg, like we just priorly stated, $2,000 worth of that product. That's the price times the multiplier. Maybe the volatility of that is 25%. Well, that's perfect, right? Because now I've got a situation where the products themselves are after adjusting for volatility here, are actually 1-to-1, because I have half the size on the front leg, but the volatility is twice as great. The back leg, it's twice as big, but the volatility is half. So now I'm just at a perfect 1-to-1 ratio between those two products that don't exist. So let's get some products that do exist in here for an example, starting out with our very simple SM75 2 sticks. And you can see here, this is not a coincidence. This is how we decided to size these products so that when you wanted to pairs trade them, you didn't have to do a bunch of extra work. SM75 currently sitting around $66, sticks sitting around $64. I know it's not perfect, and this is for those of you out there who are perfectionists and like me are constantly any little mess around your apartment or anything that's askew in your work station needs to be fixed. I get it, but pairs trading is not that situation where it needs to. If you're trying to get this to be exactly 1-to-1 here, you're gonna have to do like 75 SM75s against like 80 sticks. It's really just a futile effort. But you can see here the difference of a couple $100 I can live with on a pairs trade, and that gets you to 1 SM75 to 1 sticks. Very simple there. As we move on to a couple different examples, maybe I want to trade IWM shares, or I want to trade options against it. Well, now I've got a scenario where 1 SM75 is worth about 30 shares of IWM. What's great is those of you who are options trading gurus out there know that I can directly translate that 30 shares to 30 deltas. So if I buy an SM75 contract and I sell the 50 delta call and I buy the 20 delta call against it, I got a 30 delta call spread in there. I've got a pairs trade that's 100% hedged. Perfect hedge there with IWM against SM75. And the same goes for futures versus futures. It's just a little bit more confusing because With shares, obviously, the multiplier is just down to 1. With futures, you have to do the work of finding the multiplier. All small exchange products, the multiplier is just $100. Pretty much as easy as it gets. But you can see here, like CL, it's $1,000, and I think there's a mini CL that is, I think the multiplier is 200 or something like that. That's all going to be, irrelevant after small oil comes out, hopefully in the next month or two. But anyways, if I'm trying to trade SM75 against CL here, I got to add that different multiplier in for the CL futures contract. And this is one where I would add the volatility angle on this as well, because as you can see here, the volatility of SM75, similar to S&Ps and NASDAQ and everything else, in the mid-20s. Crude oil, it's greater than 40% currently. So, it's almost close to double that. So I'm going to add that angle in there, and I'm going to get to a relationship whereby I need 15 SM75s for one crude oil. Stocks versus crude oil. I know it seems crazy, and it's definitely not the strongest relationship, but both are risk on markets that tend to move higher in good times and lower in more fearful times. And so I've definitely seen this pairs performed in the past, but those are a couple examples that allow you to take an opinion on how two markets could relate in the future to execution in your platform. Like I said, it's really simple with the small exchange products, even going across asset classes. You want to trade the US dollar against metals. I would do that on a 1-for-1 basis, given the fact that those products, how their sizes and volatilities relate. And you can see here, if I wanted to trade, a robust stock market that has energy, financials, technology, industrials, and materials, I wanted to trade that against just technology stocks themselves. Very easy here after doing that simple number crunching that can quickly get not so simple with different products, different product types, different volatilities, and everything else. But those are the hopefully easy formulas for getting you to your ratios. And now that we've covered kind of what I view as the boring stuff, which is, okay, like how do I think about these ideas? How do I create ratios out of them? What do I think about in terms of volatility and size? Let's now move on to the fun part, bringing back in our benefits here for pairs trading. I want to look at how I tend to look for opportunity in pairs. It's not enough to say, oh, this is how you do it. You have to add that angle of, okay, if I'm looking at a bunch of products, where is the opportunity? Where do I gauge opportunity in this unique strategy? Because I want to get, this speculation on a different part of the financial world. I want to offset the risk of a single market either going, in one direction. I want to extend time in that trade. And I also want to diversify here. I can't reiterate that enough, that this is really eye-opening, especially it's like you open your trading platform at the start of the day or the start of the week or month or whatever, and you are like, all right, I'm buying or selling stocks here, and then that's kind of it. No, what's really nice is that these pairs offer so many different diversified opportunities. But let's get to it. Price action for me is almost always the catalyst for forming an opinion and thus forming a pairs trade. And that's all just to say, I don't like to read a bunch of news and follow different people on Twitter that have different opinions on things and go from their opinions to the trading platform. That is totally a viable strategy for some of you out there. But I like to say, all right, what are the historical extremes for this relationship? Where does it rest right now? And where can I try to create an edge off of that? So we're looking here at that pairs trade of SM75 versus sticks. And you can see that SM75 has been as much as $10 on top of sticks, and it's been as little as $4 under sticks. Hopefully give you a second to grasp all of that by looking at that y-axis and seeing that one subtracted from the other just merely is, okay, what are the difference between these two contracts? And so when I see that these two markets are almost at that perfect zero difference, I'm kind of like, All right, not so much opportunity in this exact pair here. It's tested both a new extreme to the downside and upside, and I don't have really much to say about it right here in the middle of the range. Now, if SM75 gets to a scenario where it's $2 or $3 or $4 under sticks, I'm looking at maybe buying SM75, buying this pairs against the sticks there, because you can see it's bounced off of those levels several times in 2020. And so what I'm doing there is just creating a price extreme trade where I find the edge in certain levels that the market hasn't been able to get through. Same with the upside. This market has reversed off of $5, $6, or $7 of difference multiple times in 2020, and as recent as about a week or two ago, it got as high as $6 of difference of SM75 on top of sticks. If it gets back up to those levels, I'm looking at the short version of this pairs trade, which is short SM75, long sticks, and that's also, as a quick aside, that's how I always, and I think most people in the industry think about pairs in terms of that front leg. Now, what I mean by that is if I'm long the SM75 sticks pairs, that means I'm long SM75, short sticks. If I'm short it, same thing. Now, that being said, if I flipped these and put sticks minus SM75, what you would get is this visualization just completely inverted across the y-axis, or sorry, the x-axis, which is, for those of you out there don't understand what that means necessarily, just flipped over a horizontal axis. And so you'd have the same price. It would just be those positive values would be negatives and those negatives would be positives. And in that scenario, if I'm long sticks SM75, I'm long sticks and short SM75. I hope that didn't add confusion. It probably did, and I'm sorry for having done that. Moving on, though, you can also create pairs trading opportunities just out of trends. And this is a scenario where if you look at more historical data, here I added the about 10 years of data, and I'm looking at just merely technology versus energy. And you can see here that technology is not only up over 400%, but it's outperformed energy by even more than that, because energy in the last decade is actually lower by about 30-40% there as a sector. So here is a scenario where I'm adding more historical context. When I'm trading off of price action and different price extremes where the market's been, I'm usually looking at a few months to about a year. When I'm looking at bigger trends in a trade that I think will play out more over time, you add a couple of years to it, and you can see, wow, big difference here. I think almost all of you would probably have an opinion of this chart. It's almost like a Rorschach test, and it could let you know if you're a contrarian or if you're a trend follower. Neither are necessarily right or wrong. It's like Harry in the Sorting Hat. Being part of Hufflepuff is not bad. You just have to find that out for yourself. But yes, some people would say, hey, I need to sell that technology and buy energy for a reversion trade. Or some would say, hey, technology is going to continue to beat the hell out of energy. I am going with this trend following trade, and these are going to continue to split. So sometimes it's as easy as that, just pulling up. And I know that platforms a lot of times don't support having multiple prices on the same chart, or being able to plot the pairs themselves. That's totally fine. Like I work within my primary platform that I look at for visualization, trading, and everything else doesn't have that functionality. What I do is I simply will type in, SM75, and then I'll jump right over to sticks, and I'll just keep my time frame and everything else static, and I'll form my opinions and everything through that. So, don't get too down on your platform if it doesn't support charting like we have in front of you from our great production team over here at the Small Exchange. Just bounce back and forth between products, and you should be able to relate things, especially when you've got if you're looking at a weekly chart for the last decade. I think you should be pretty easily able to visualize these in your platform, even if pairs quoting isn't supported. Also, you might not even need to graph things out on a platform, because maybe you're not looking at price action, or you're not looking at trends via price history. Maybe you're just looking at economics and your research from different media outlets, such as the stocks versus bonds trade here, whereby you can say to yourself, Stocks are at all-time highs. Bonds, as I've read, are actually kind of near the historic lows. Maybe I've got an opinion on these two markets that are historically positively correlated. And I'm talking about bond yields there, not to confuse with the earlier example that I gave with bond prices. And you can see it here also in the charts that these two products, different asset classes, the S10Y, which is the 10-year yield, versus the SM75, which is a stock index, two different asset classes that, as you can see, move very similarly. But what you also can see is that from 2020 until now, they have diverged greatly. You've got an SM75 market that has put in new high after new high and is now almost, like $5-10, like $10 above its 2020 highs there. You've got an S10Y market that's not even halfway back to its highs of 2020. So, economics and the way that everything relates from a textbook point of view can also function into all these different things. The same with a lot of people talking about trading agriculture markets. Well, how does that US dollar relate to the agriculture market, and how can I create a trade out of that? If I want to be long ags, I can get long the US dollar as a little bit of a pairs or a hedge, because if that dollar strengthens, then ags might move lower. And now I'm rambling a little bit, but that's all just to show you how many opportunities are out there. We're mainly in equities, and you got a little flavor of interest rates here, but every asset class has like tens to hundreds of permutations of different pairs trades. It's really such a wide world that I'm glad all of you are jumping into here. And then also I want to get a little bit to that component, which is the risk reduction and adding time. So put your eyes, if you will, please, on those y-axes here and look at the fact that in black we have SM75. Its range for the last year from $30 all the way up to $70. And that's every dollar there from small exchange products is worth $100 notionally, similar to just 100 shares of stock. You look over on the right side, you get the sticks y-axis in red, which ranges from similarly about $30 all the way up to $65. Okay, so that's $35 or $40. Let's just round it off to $35 times 100. So about $3,500 worth of movement between these two markets for the last year. Those are the markets on their own. Between $3,000 and $4,000 worth of movement in the last year. Now, when we add them together, keep your eyes on that y-axis. When we add them together and create a pairs out of them, you'll notice that y-axis now has gone from a range of $30 to $40 to about $15. Now, that is what we call hedging or risk reduction or whatever else buzzword term you want to use that's baked into the idea of pairs trading. That difference between SM75 and sticks, the pairs itself, has actually accounted for less than half the movement of the outright markets. That's great, because that tells me, like I said in that example earlier, if I'm willing to make or lose about $500 and I'm doing it in these outright markets, I'm going to have less time in that trade because they're moving, $100 per day. But I can see here the pairs moves about half of that. And so, hey, my pairs trade, given my mechanics and where I want to get in and out of trades, can last me about, given this example, about twice as long, which is really nice. And then the last piece here, that diversification, which I promised earlier, is there. And I know there's a lot going on in this chart, but now I've plotted the pairs market against the two outrights themselves. And you can see here that this pairs market is moving back and forth, up and down. Sometimes when it's really low, these equity markets are putting in new highs. Like if you put your eyeballs on the October-November region of this chart, you can see sticks and SM75 making new highs as the pairs trade is actually near the lows, and then it eventually bounces higher. The pairs trade goes to the highs, and then actually in the last, then if you put your eyeballs at the last week or so of trading, you can see the pairs coming off huge, a big move to the downside as those two equity indices sit at their highs. This is the diversification of this strategy, which I love, because it allows me to, say, hey, I think equities are going higher or lower in the next couple of days or weeks or months or whatever. And I've got that in my positions tab of my platform, and I can add pairs trades because it's a different look at these outrights. I'm not Texas hedging. For those of you acquainted with that term, I'm not adding risk to the same position. I'm creating a diversified strategy here. And thankfully, now I'll move into just shamelessly plugging the smalls. Pairs trading with the smalls is small, standard, and simple. You go across these different, as we showed here in equities, it's very easy to go one for one, given the sizes there. Going across asset classes, similarly easy. You want to trade metals versus dollar has been an interesting one for me recently. U.S. dollar versus the U.S. Treasury yield, that's an intriguing one. And like we touched on a little bit, that Treasury yield versus stocks is for equity futures and all asset classes, traditional futures markets. Those of you out there who have traded traditional futures for years and years know this. This is about as easy as it gets when it comes to pairs trading those futures, because I absolutely have hated in the past when I was at the Board of Trade doing interest rates. Oh, okay, well, what's the ratio between the euro dollar that's expiring in June of 2025 versus the 2-year Treasury note? Different multipliers, different volatilities. It's all a pain. Small exchange trying to make that as easy for you as possible, and also as small for you as possible when it comes to the product sizes themselves. The two equity indices that we were looking at today, those futures are at a size of about $6,000 relative to the E-minis. The E-mini NASDAQ right now, I don't know if you'll believe me saying this, $270,000 contract, which makes that micro still $27,000, which is almost 5 times as large as our small exchange equity indices. And then also coinciding with that, our margins are going to be lower than those big traditional products. And here, what I like about this slide is the margins are all there in front of you from the small exchange side. Might be a little different depending on your brokerage. But you can see here just within these 5 products how many permutations you can build. And this is really the empowering piece that I guess I'll leave you all off with today before getting into some Q&A. Is like, okay, I've got SM75 versus sticks. We talked about that for the majority of the presentation. I also can trade those stocks against metals. Metals have been highly correlated for the last year of trading. I can do a buy-sell pairs trade there. Like I touched on a little bit, I can trade metals versus the dollar because gold, silver, and platinum, they're priced in US dollars. There's a trade there. And already you can start to see how when your brain unlocks pairs trading, how many strategies you've opened up. Even looking at something as simple as the Dow Jones 30. Okay, there are 30 stocks in there. I can trade the Dow Jones against one of the stocks. I can trade one of the stocks against another one of the stocks. I can trade the Dow Jones against the SM75 or against the Russell. There's so much opportunity in there that lets you go beyond simply buy or sell this asset class and living with that decision. So that is the pairs trading, how to do futures. Thank you so much for joining us.